Hello, and welcome back to the Foreclosure Deals Coach podcast. This is the show where I help regular investors like you to find, figure, fund, fix, and flip a foreclosure deal. In a lot of cases, though, people are looking to elevate from single-family residential investment to going to the next level of investing, which is multifamily. And multifamily is an expensive prospect unless you start looking at syndicating funds, bringing in private capital to build out new family developments or to buy existing ones. Today, I am honored to have Kent Ritter on the show to discuss how he raises capital and helps people to syndicate their capital into deals in the multifamily space. This is going to be a great show. Stay tuned. Hello, and welcome back to the Foreclosure Deals Coach podcast. Once again, the show where we talk about finding, figuring, funding, and fixing a foreclosure deal. But for a lot of real estate investors, single family is just not enough. Once you've mastered that area of finding deals, turning them into profitable deals, you've bought some single family rentals, you start to realize that the big money, the major play for real estate investing lies in the multifamily space. But when you're playing in the multifamily space, you either have to be heavily capitalized or you have to know how to get capital to do deals. Today, I am privileged and honored to have Kent Ritter, founder of Hudson Investing, with us to discuss how he raises money for multifamily deals and how you too can jump in on the deals that he's doing right now and get an incredible rate of return working in multifamily investing. Kent, thank you so much for coming on the show. How are you doing?
I'm doing great, Donnie. Thanks for having me on.
Absolutely, man. Excited to have you. Well, let's get started. We'd like to go with the origin story. Obviously, you're in real estate investing. We're going to dive a little bit more into your specific part of real estate investing. But before we do, let's talk about how you got to the real estate investing game. Can you tell us kind of how you got started?
Yeah, sure. So I got started investing in real estate back in 2013. And I got started like it sounds like a lot of the folks that probably listen to your podcast got started. I started in single family. I started doing fix and flips. We bought some pretty ugly houses and turned them into something that was nice for some nice families. But that just became a grind, and it became difficult to scale. Mm-hmm. And honestly, as I just, you get in, and I feel like you start, at least I did, just asking people, what they were doing, right? And the people that I knew, that's what they were doing. Didn't mean that was the best strategy.
Sure.
But I started doing what they were doing, and realized, after we had done 11 or 12 of them, that it was really difficult to find good products. It was difficult to manage, and it was definitely it was a full-time job, which wasn't what I was looking for, because I still had a full-time job at that point. And so as I educated myself, I learned about multifamily. And just like you said, I essentially, let's say, graduated to multifamily. And really from the premise that you could, instead of having to go out and buy 100 houses, you could buy 100 units under one roof, and you could have one transaction. And really it is, it's not much more difficult. In some ways, it's a lot easier to buy a large multifamily than it is a single family home. And it's a lot of the same work and same effort. So that's what really got me into multifamily. That's what got me into starting to invest really first with other people in multifamily deals. So I was still doing single family. I started investing with others as a way to learn, to be in those deals. I was a passive investor. I was giving them money. They were out running it, but I was asking questions. I was learning. And that really brought us from about 2013 up to 2019 when I founded Hudson Investing, because I felt like I had learned a lot. I had gathered mentors and coaches. I'd been through several deals. I understood the mechanics, and really started Hudson Investing in 2019 as a way to start to do these deals on my own and start to bring my own friends and family in and start to help them have a vehicle to share in the value of owning multifamily, without having to do all the work themselves. Mm-hmm. And that was really the genesis of it, was to be able to give people access to all the benefits of directly owning real estate without having to do all that work that I just talked about. And so since 2019, we've grown to just over 1,000 units in our portfolio. It's not just me. I've built up a great team around me of real estate professionals who have been doing this their entire career. And now we just can provide that kind of white glove service and expertise to allow our properties to perform the absolute best and give great returns to our investors.
I love that. And I love that, the story makes it so realistic, Kent, because, all the things you said pattern very well with my coaching program. It is a team around you. Like nobody gets there by themselves. That's a critical element, right? You started in the single family residential space. So you got your teeth cut a little bit before you went into the multifamily space, which I think is critical. Would you agree that it makes sense to start at residential based on your path to learn that process first?
I think if I was going to do it all over again, the way that I would approach it, and if I was young and I was starting out, right, I would house hack. I would buy a duplex. Okay. I would live in half of it and I would fix up the other half. I would rent it out, and just learn what it means to own real estate and learn what it means to be a landlord. Yes. and see if that's what you're into, right. If that works for you, but also, in doing that, you can get that one. The ideal is you have that other unit pay your mortgage. And so you've offset some of your expenses. It gives you that freedom. And you can just continue to do that over and over again for, let's say 5 years. Mm-hmm. And you end up with 10 units at the end of it. And that's really how I would start if I went back.
Okay. I love that. And, my advice is along the same lines. You want to build single family residential units as you go. It is, accelerating the fix and flip thing, I think gives people some capital to get going, but you're in capital raising, which is another step, right? Where you're able to assimilate other people's money. Obviously there's a legal process with that. You got to form a PPM. There's different regulations, 506B, 506C. I don't bore people with all the nitty gritty details on that. There's a structure and an expense to that, right? When you're first getting going. So when you were first getting started out, when did you realize, the transition was, I guess, cost effective based on what you were doing? How did you know it was time to go to the higher end level and start raising capital?
Well, it was really about being able to go out and buy bigger and better assets than any of us or I could on my own. Sure. Right? I knew that by pooling our money together, we could go buy bigger and better assets. It would ultimately be safer, ultimately have a better return. And so that was really the idea, because as you scale up in multifamily and as you get larger and larger properties, and they become easier to manage, you can get better property management, you get better economies of scale, meaning you get discounts and it's kind of cheaper per unit. And there's just a ton of benefits, and you offlay a lot of risk, because if you have a 100 unit property, you could have 10 empty units and you're still at 90% occupancy. Right. And on most of our properties, we only need to be in the 70s to break even. So we're still making a profit even at that. Versus if you have a smaller property or even a single family, if you have one person gone, you're back paying the mortgage. That's right. And so, there's a lot of risk there. And so for all those reasons, why it made sense. And there is a cost. There's a cost. You need to hire a good attorney, an SEC attorney who knows what they're doing. But if you do it right, it's absolutely worth it.
And I think a lot of it, you're right. Getting the right attorney in the structure is critical, and there's an expense there. And that we don't want to just get caught up in the expenses, but it's the experience, right? Have to take that document the attorney has created and go out and raise money from people who a lot of them already know and love you, right? You mentioned friends and family and whatnot, but you have a lot of strangers in here too, right? Where you're raising capital to people who have never met you before and setting up those conversations. I think your background in it becomes critical to raising capital for that. Would you agree with that?
I do. I think track record is important. I think your first round of investors, your friends and family, right? Because that's what it really started with, right? Okay. And then now we're probably, 5 or 6 degrees out from that. Right. As we've brought a lot of investors into our network. I think we have a couple thousand now. But it really started with that, right? And then the way we've grown, we've mostly grown through referrals. Sure. And through myself, doing shows like this and folks getting to know us. But so at the beginning, folks are going to invest with you because, they like you and they like who you are as a person. They believe you're honest, and they believe you're going to do the right thing, but as you get out out from just your friends and immediate family, then it really becomes about track record, right?
Yes.
It becomes about experience. It becomes the ability to show wins and show success. And it is tough at the beginning because it's kind of a chicken or egg thing, right? Where, well, how can I have success in real estate if I can't get money to do deals, right?
Right.
But I think for me, that past kind of single family experience helped. I think the fact that I had done a lot of investing with others had helped. I mean, I'd been investing in real estate for about 6 years at that point in a lot of different facets. So that was helpful. But also I had, started and sold another business in a completely separate industry.
I see.
And I think as you look at people that are starting out, they may not have real estate success specifically in what they're doing now, but I think if you can show a track record of success in something else and relate that to how that's going to make you successful in real estate.
That makes sense. Yes.
For me, it was about starting and scaling another business. Right. And at the end of the day, a multifamily property is a business. It has a profit and loss statement. It has income. And so I was able to relate that story, and I think that was helpful. And now, as we've gone further out, and now that we actually have a track record and we've bought and improved and sold deals and we made great returns for our investors, now we focus more on that, on what we've done within Hudson.
Sure. Sure.
And so it becomes easier over time.
Right. The more you do, the more people believe you can do it. And there's some struggles along the way. I think people get to multifamily a lot from the gurus that are out there pitching, where you got to go buy an apartment complex. It's a great idea, right? But if you don't have that business background, I mean, it's actually multiple small businesses in a way. It's almost like every door in a way is another income stream, and thus a business that you have to operate, right? And I think people, I don't want to scare them off. I mean, there's a management process. You've obviously built a system for doing it, but it's another business. It's something you either have to have business experience already, or to your point about getting started, you started with flipping or single family residential rentals, and you worked your way up to it. I think what I'm alluding to is just, it's so important to have some kind of business experience before stepping into this. It's going to be difficult enough to fund without that. But if somehow you could fund it without that, you're going to certainly wish you had some background in it before you get to 50 doors, right?
Well, I would say that I think people generally underestimate the effort and the difficulty of owning real estate. I have conversations with people all the time that are successful business people, right? They're successful in whatever their career is.
Sure.
And they're like, I think I'm going to go buy a duplex or buy a quad. Right. And like, it's going to just be really easy to go do that. And it's automatically going to make money.
Right.
And I always caution people, just because I've been there. I've had, I had 12 rentals, single family rentals at one point, and it was a nightmare. I mean, it was a management nightmare because you can't pay somebody enough to manage them at that point. So you're doing it yourself. And
so true.
It was a heck of a lot harder than what I'm doing now in multifamily because of the scale. And so I always caution people and say, look, you got to decide if you want to buy yourself a second job, because that's what you're doing. And people think it's passive in real estate. It's not. It's not at all.
It's just
and the problem is, if you only have, let's say, one unit,
right?
One the resident leaves, right, and there's no income. But two, you might only be making a couple $100s a month off that rental. And if you have a water heater that goes out, right, I mean, that could suck 6 months of your income away right there.
Absolutely.
And a lot of people aren't preparing and reserving and putting money aside for those rainy days. But so the whole idea is just, I think people underestimate how difficult it is.
Yes.
I think people think, I'm just going to go buy a rental and that tenant's going to pay me and it's all going to be good. Well, often they don't, and other things happen. So I just tell people, look, you've gotten to where you are, and we're having this conversation because you're really good at what you do. You've spent a career learning about what you do.
Right.
I've done the same thing on the real estate side.
That's right.
We are experts, and I have a team of experts. And so let us do what we do. Let us diversify you into real estate without the hassle, right? While you go and focus on what you're good at, and you generate as much income as you can in what you're good at. Don't try to divide your attention and be half good at two things.
I love that. And it's so accurate, right? Really, it's focus. It's about focus, so investors can take their capital that they've earned from flipping with me or whatever other source they're using, and they can put it into your fund. And that does turn into an actual passive investment, right? Because now they're not managing the day-to-day operations of running a 50-unit apartment complex. Instead of that, they're now getting an income. Can we talk about rate of return on that? I know it's all theoretical, kind of based on the deal, but what do you target on a typical acquisition for the internal rate of return? And if you could go into how internal rate of return works a little bit for people.
Sure. So I feel like internal rate of return can be difficult to explain, but essentially what an internal rate of return is, it's the best way to evaluate a real estate investment up next to, let's say, the stock market or another type of investment, right? Because your investment decisions are always like, well, what are my alternative, right? And what's the return and what's the risk?
Absolutely.
And so an internal rate of return, really what that does is it allows us to say, based on the money you put in and the cash flow that you're going to receive over time, because most of our holds are 3 to 5 years. So over time, you're going to receive quarterly cash that are like, kind of like you think about like a dividend payment,
Yes.
but it's a payment from the operations of the property, your share of the income. And then at the end, we're going to sell the property, right? And you're going to get your share of that appreciation from the sale. So if you take the money you put in, all those cash payments, plus the amount you're going to get when we sell, and the internal rate of return brings all that back. And okay, well, what is that percentage return annually, right? So you do all that math, it tells you, okay, that's a 17% return annually over the 5 years. So over those 5 years, it's like you made 17% every single
Per year. Correct.
Right. And so that's really what it's doing. And it's really a way to communicate, how the type of returns we will provide versus, as you're evaluating other investment options. And so every deal is different. I mean, it's difficult to really put out a target, but I would say our bare minimum is we're really trying to provide, we won't take a deal out to investors. We won't put a deal under contract if we don't think we can provide a 16% IRR, so annual return, to investors within that deal, net of all of our fees, right. And just all the fees it takes to buy the property and do everything. Right. So that's really our baseline. So then from there, we'll go above that. I can tell you our track record rate of return is about 21%.
Wow.
Over 4 years. So an average 4 years, about 21% return every year over those 4 years.
That's incredible. And one of those things, as you alluded to, very tough to do in the stock market with that level of consistency. Plus you have the backing of a hard asset, right? That the stock market doesn't generally offer. So there's a lot of benefits to investing in a fund like that. The rate of return is generally consistently higher in a sense, and it reduces some of the risks. So it kind of becomes a no-brainer. You mentioned quarterly dividend payments. Is that standard issue for one of your products? Is it usually a quarterly dividend?
Yeah, it's quarterly, and what it's called is a preferred return. So all of the way our investments are structured is we have a preferred return in our deal. What that means is, and the preferred return is usually about 7%. So what that means is the first 7% annually every year, all of that money goes to the investors.
Okay.
So the investors receive 100% of the money up to a 7% return on their investment. So if they invested $100,000, up to $7,000 a year, right?
Yep.
Then above that, we start to split the return, and that's how my team and I start to make money.
Right.
So we've got to get you that first 7 before we start to see a split of any of that.
I love that.
And then above that, there's kind of a sharing, whether it's 80-20, 80% to the investors, or 70-30, 70% to the investors, depending on the deal.
How far does that gap from the 7 to what? Does it go to, you're splitting up until what point usually?
7, and then really just above 7, we begin to split the returns.
Different ways. Okay. So not necessarily, not a 50-50 split, but a split depending on the deal, where what the firm keeps some of it and you keep some of it.
Correct. Not 50-50. It's usually about 70-30, 70% still going back to the investors.
That's awesome. Yeah, because in this case, the investors are making your deal possible. So it makes sense to incentivize them, one with the preferred return of 7%, that's a great rate of return in and of itself, right? And then on top of that, you get the benefit of when it does better, and these projects almost always do better than 7%, obviously. then they get an additional return that's in advance of even what your firm makes. So I think that's incredible. And then you mentioned it's a 3 to 5 year turn time generally that they're in the project, and then you guys are looking to exit the project by selling the unit and getting the capitalization. Does the IRR factor in appreciation as well?
Yeah, absolutely. The IRR factors in the appreciation at the sale. So it's a complete metric. So if I tell you it's going to be 17%, that's net of all the costs. It's including us splitting some of those profits, as we get above that 7.
Okay.
It's still that 17 going directly to the investor, and it's holistic, wraps up everything within that deal.
I love it. It's incredible. So if people are looking to get started in investing, there's the words accredited and non-accredited investors are thrown out. This is a fund, as I understand. It depends on the project, but most of your projects looks like they're 506Bs where they're allowed to be solicited to people who are non-accredited investors. Is that correct?
So we do both. We do 506Cs, which means you have to be an accredited investor, and we do some 506B deals, which means we can bring in up to 35 unaccredited investors. The important thing with the 506B is we have to have a substantive pre-existing relationship. That's the language from the SEC. That means I've got to know you well before I offer you an investment. So that's why it's important that people sign up at our website, they get on the phone, we have conversations, we understand about them, because we've got to let a period of time pass where we get to know each other before we could even present a deal.
That makes sense.
And so
go ahead. Sorry.
Oh, and the other thing I was just going to clarify for folks is an accredited investor is, it's an SEC term. And what that really means is you make over $200,000 a year or $300,000 a year if you file your taxes jointly and you've made that for the past 2 years, or you have a net worth of over $1 million, not including your primary residence.
Right.
So you've got to meet those criteria to be an accredited investor and be able to invest in most of our deals.
Yeah, which keeps a lot of people from doing so, and that's why it's interesting that some of your offerings are actually available. A certain amount of them can go to non-accredited investors. What's the minimum investment typically for one of your funds?
It's typically $50,000 to $100,000.
Okay,
depending on the deal, and we don't have a fund in that we're asking you to put money in and go out and find, and then we'll say, okay, we're going to find several properties to deploy your money into. We are always project asset specific. So we find the asset and say, this is a great asset. We're going to buy this asset. And that's what we go out and tell people about. We say, hey, here's the asset. You can touch it, feel it, look at it, understand what you're getting, versus saying, trust us, we're going to find something that's like this.
Right.
But you can't directly decide which assets your money goes into.
I think most people prefer that, right? Knowing what the address of the investment they put their money into. I think that gives me anyway. It gives me a little peace of mind knowing that I bought this specific property or I'm an owner in this specific property. I think that's just a better way to go. So that's an awesome route. You do hear a lot of guys who are just general funds, which is why I keep alluding to that. But in your case, I like that it is property specific. So you guys are out there looking for the best deal, much like I do for my clients. You find the deal that you like, you pitch it out to your clientele, you tell them the minimum, they decide how much they want to contribute to it. And then obviously they know the deal structure, how much return they're going to get, and what you're hoping the exit is going to be when you sell the property in 3 to 5 years. I think it's an awesome opportunity. I'm going to pop the website up here, HudsonInvesting.com, but tell people about the process, if you would, Kent, about getting in touch with you, having that necessary conversation to move forward about talking about deals and how they can kind of start that conversation if they want to get going.
Yeah, it's really easy. Just go to HudsonInvesting.com. Right at the top of the website, you can click the button to sign up to become an investor and get on our list. And from there, we've got a great investor relations team that'll reach out and have those discussions with you and kind of walk you through the process. And really, we've built this all around, my experience coming from being an investor first, and investing with other people in these type of deals and say, what did I like and what didn't I like? And so we really put a lot of effort into creating kind of a white glove experience, walking people through it. We have a lot of investors that it's their first time. And so we really try to make it easy for folks. So we've done a lot through education to help people really understand, what they're getting involved in. So yeah, it's really easy to sign up. Just go to the website, click that, and then one of our folks will be happy to reach out and get on the phone with you and walk you through the process.
I love that. Kent, a lot of people want to get into real estate investing. This is a show primarily for people who are looking to bridge that gap between getting started and doing their first deal. When you were obviously in that position years ago when you were starting this, what would you tell somebody, about the importance of getting some help when you're getting going in your first deal? What was your story in determining this was the life path you're going to take, and who helped you along the way?
Sure. So I've had I heavily believe in coaching and mentorship, and I believe in, I've heard people say, which I like, you're going to pay your tuition one way or the other.
So true.
And so, I know that I've spent hundreds of thousands of dollars on coaching and mentorship, and I know
Me too.
that I've gotten a great return in that investment. I mean, it sounds like a lot of money, right? Yeah. But I know that having those people available and being able to avoid the mistakes that they've made has saved me millions of dollars.
No doubt.
And so I know there's a great return on that investment. So I absolutely believe in coaching and mentorship, especially when you're getting in something new and you haven't done something before. I mean, there's so many easy lessons learned to avoid, right?
Yes.
And so, I've done that in several ways. I've done that through actually going out and finding paid mentors. I've done it through unpaid mentors, where you're just finding people in your community that are doing what you want to do and reaching out to them, and
yes.
Finding a way to be of service to them and just get involved. And I've also done it through investing in other people's deals. I mean, that's a great way. If somebody's out doing what you want to do, which someone's out syndicating apartment buildings, a great way to get their attention is to invest in one of their deals.
Yes.
That was one of my best mentors. He became my mentor through that process. I started investing with him, started getting to know him. And, we started working together, and, he started really mentoring me. And that was a huge benefit for the growth of my career.
I love that. And it's so valid. Find somebody who's doing what you're doing, either join on their team somehow, invest in their fund, do a deal with them. That's a critical way to do that. That's really what I offer to my students as well. And I love that. It's like, we're going to do a deal together. That's the best way I can think of for you to learn this, but you need to find somebody actively doing deals. There's so many gurus out there who are selling education. What you're talking about is partnering up with somebody who's actually doing deals actively. I think that's a big variable in what's available out there in the education space today.
Yeah. I mean, there's, and I don't know if this is my own echo chamber, but I feel like when I go on Instagram, all I see is real estate gurus, and it's probably because I'm interested in real estate, but there's a lot of advice out there for sure. I do think it's important to understand the experience behind that advice.
Yes. 100%. Find the resume. And I always tell people that, obviously I want to be selected as many people's coaches makes sense, but you need to know a background of whoever you decide to go with. What have they actually done? And what are you going to get? What interaction with that person are you going to get in order to get the desired result? Otherwise, you can just kind of throw money down the toilet with these coaching programs and mentorship programs. But, I pride myself on a system where we're guaranteeing they're going to do a deal because I have all the experience. And in your case, they're literally investing in a deal. Right. So there's no risk of the money being put in the wrong place because it's going into a specific deal. They're going to see the genesis of that deal, the acquisition or the building. They're going to watch it cash flow, and then they're going to get their return back when they sell the property. It's an amazing way to jump into multifamily. I think it's a huge opportunity for people who have the capital and desire to get started. We're pretty much into the show today. Kent, any parting words about real estate investing, life, mentorship? What would you like to leave the people with?
Well, I think I've given a few good nuggets out there. I'd say if I was going to leave folks with something, I think everybody should own real estate in one way, shape, or form, right? I think if you look at diversifying your investments, I think people are too heavily weighted into stocks because that's all we're advertised about. It's all we know. I think everybody should be in real estate. I think if you look at the richest people in the world, they on average in their portfolios have about 20 to 40% of their portfolios are private investments in real estate. Mm-hmm. I just tell people if it's working for them, don't you think it's going to work for you too? And I think the average Joe out there is just under allocated in real estate and should find a way to get involved because it's going to help them make money. It's going to help them reduce their risk. And it's also going to help when the stock market goes on those roller coaster rides, have kind of a steady foundation in their portfolio.
Yeah, that's great advice. Real estate's far more stable of an asset over the long term. Stock market has much more fluctuation, and there's a shortage of housing, right? You got to go back to that. Like in general, nationally, there are less available units than there are people who need those units, and that's across the country. So your asset class, where you are placing your investors' money, is a very stable place to be because there's always going to be a need for housing, but there's a particularly high need for it right now, which is a great time to be in it. Well, Ken, thank you so much for your time. I really appreciate taking it. We're going to put the website up just one more time here. But guys, you want to head out to Hudson Investing if you want to get started, have a conversation with Kent and his team about the projects that they're working on right now, establish that initial relationship that's required by the SEC. And then you can start getting deals, at least find out what deals Kent is working on to see if one of them feels like a good fit for your portfolio. Kent, thanks for your time, but I really appreciate the time.
Sure. Thanks, Donnie.
Well, guys, you heard it here. The reality is the market's changing a little bit. There are some things out there that that you need to be considering as you're growing your real estate investment career. It isn't just about single family residential. That's where we get you started. But if you want to do bigger stuff, if you want to work to the next level, it makes sense to partner with a guy like Kent Ritter and Hudson Investing to get your money in a huge internal rate of return, 17 to 20% internal rate of return. While nothing is guaranteed, this is a very stable investment that can put you into real estate products that would otherwise be unattainable. It's really just a matter of the connections that you make, who to talk to, and make that kind of money on those deals. With that, I thank you guys for tuning into the show. It means a lot to me. And remember, if you want to get started in real estate investing in the single family space, particularly foreclosure investing, reach out to me. Let's have a conversation to see if that's a good place to get started so you can build the funds to invest in a syndicated deal like what Kent offers. With that, this is Donnie Corum, your foreclosure deals coach. Thanking you so much for tuning in and reminding you now and always, don't buy a house, buy a deal.